Welcome back. We're about an hour and 15 minutes away from the opening bell for Wednesday. Markets are mixed this morning. Take a look at futures, indicating a decline of 200 points this morning on the Dow Industrials, but the Nasdaq and the S&P 500 are currently higher. The Nasdaq up 50 points. Investors are waiting on a big day of big tech earnings. Plus, the Fed's July rate decision happening this afternoon. We will hear from Kevin Warsh at 2:15 p.m. Eastern. We are not expecting the chairman to raise interest rates. However, his commentary is closely watched for any leanings of quantitative tightening. Markets were mixed yesterday. We had weakness in technology and chip maker stocks in particular. And this morning, we've got a mixed showing there. Hynix is down. SK Hynix, rather, pardon me, is down 10% in Korea, and that sent the Korean market down sharply. Oil prices on the rise as well. The U.S. and Saudi-backed forces confirming that they've responded to Iran with massive hits on Iranian military sites in Iraq after the IRGC fired at U.S. bases in a failed surprise attack. The price of crude is now at $83.02 a barrel. That's up almost 5%. Joining me now is the chief global economist at Piper Sandler, Nancy Lazar, back with us. Nancy, great to see you. Thank you so much for being here. And I want to get your take on the backdrop here, because I know you've talked a lot about productivity. You've talked about the jobs market continuing strongly. How would you assess the economy today?
The economy is actually getting healthier in that economic activity is broadening out into more sectors. To be sure, the capital spending has been driving growth, and it was led by the tech sector. But increasingly, we're seeing that broadening out. And we think in 2027 in particular, you're going to have clear signs of the construction of not just data centers, but also factories. That's so important because the strength in capital spending is underappreciated, as you just said, as a factor driving productivity, profitability, and therefore jobs. And so you are seeing a shift up in goods producing jobs. By that, I mean mainly led by construction jobs. And those are high paying jobs. Great news for the middle income consumer being able to plow through what is still a somewhat of a sticky inflationary environment. So broadening out is a key theme, from tech to non-tech capex, from the high-end consumer driving growth to the middle-income consumer now also supporting consumer spending.
All really good points in terms of what's going on here. And Secretary Bessent was with me last week talking about this huge move in productivity, something you've written about so much. Here's the Secretary with me last week. Watch.
This is a generational technological boost. President Trump came in and became one of the great supporters of this very important technology. President Trump is allowing the AI companies and the data centers to build their own power generation. So we're seeing it there. We're seeing it up the supply chain, and this is kind of a once in a generation or build out. On the other side of this, we are going to see big productivity growth, and really that's how you increase national wealth, is through productivity growth. The U.S. is the home for this. This administration supports open source models, but what we do not support is IP theft. And if we see, especially, that overseas models are stealing from our great companies, we have the ability to sanction them because of this theft.
Yeah, a lot there, Nancy, because we were talking about AI and the models there. But the main point on the macro story is something you've talked about so much. Now, you wrote yesterday or this morning about the GDP coming out on Thursday. I want to get your take on that, because yields this morning are spiking again. Look at the 10-year. The Federal Reserve makes its rate decision today. We are expecting Kevin Warsh and the Fed to hold rates steady for a fifth consecutive meeting, Nancy. But the markets are pricing in a roughly 78% chance that the Fed hikes rates in September. The yield this morning up almost 3 basis points, sitting at a level of 4.63%. You write real GDP for the second quarter probably gaining just 2%. However, the real domestic final demand will grow roughly 3%, supported by strong AI-driven capex. Tell us more.
No, exactly. Trade has created a lot of volatility into that headline GDP number. And so if you look at just domestic demand, led by capital spending, the number will be closer to 3%. But the other factor within GDP that we're really focused on is what's called nominal GDP. And that's actually growing closer to 6%. And that's relatively healthy. It's at the higher end of its historical range over the past 20 years. And that actually is what drives bond yields. And the bond market has figured out that the underlying trend in the economy is very solid. I'm tempted to say strong, but I'll stick with very solid. And that 6 nominal is what is actually driving bond yields higher. When I say nominal, the investment community should think of corporate revenue growth, which are growing closer to 7 if you look at overall companies, closer to 10 to 12 if you look at S&P 500 companies. And so again, highlighting that one, the Fed is still very supportive of growth. Fed funds of 360 with nominal GDP growth of something closer to 6. The Fed is still very accommodative. You see that in money supply is accelerating. It's growing almost 7% over the past 6 months. Bank loans are growing closer to 8. Actually, government spending led by defense is also reaccelerating. So you have a lot of nominal dollars being sent into the economy, supporting this nominal GDP growth. And the bond market, quite frankly, has figured that out, and that's why bond yields are increasing. Our other point, though, is that they're not restrictive. Given that nominal growth, given that they've really been moving in a sideways channel for the past 2.5, 3 years, unlike back in 21, 22 when they increased from 0.5 to 5%, the bond market is not yet restrictive on the economy either. Again, incrementally also net supportive of growth.
And you mentioned trade. The trade deficit narrowed to 101.5 billion. That was a decline of better than 4%. But you're talking about the impact of tariffs as well on the next GDP number. But Nancy, I want to get your take on your expectations for the second half of the year. I mean, tomorrow is the first read of the second quarter GDP, and I know the expectations are 2.1%. But, we were talking with Kevin Hassett recently, and he was looking at the second half of the year at 3 or even 4% growth. You've also got the PCE index out tomorrow, and that's expected to be a decline of 0.1% from the month of May. And Nancy, I know that is the Fed's favored inflation metric. So we'll be watching what that number does because of the impact on the Fed as well.
So timely data, if you look at tomorrow, also we'll get unemployment claims. That to me is one of the single best economic statistics. It's a hardcore number, the number of people signing up for unemployment. It's in a declining trend. It's down almost 9% on a year-over-year basis. That does mean the economy is accelerating as we go into the second half of the year. I would agree with a 3% type of a real number. But again, I'm going to focus a little bit more on domestic final demand, and I think domestic final demand could be closer to 4% in the back half, given the strength in capex and what will probably also be a pickup in consumer spending. Headline inflation absolutely will be tame, but at the end of the day, core inflation will probably still increase about 0.2. It's still a little sticky in inflation, and I think you see that in the strength again in nominal GDP growth.
Yeah. Still a very good backdrop for this market, that's for sure. Nancy, it's great to see you as always. Thank you.
You too. Thank you.
All right, Nancy Lazar joining us.